Hey, Bulls and Bears, we are back with another dose of economic reality. Thank you. It's been 4 or 5 days since I put out a financial video, unless you count the video that I put out explaining why I wasn't doing videos for a few days. But if you don't count that one, I think it's been 4 or 5 days. So, welcome back to the channel, back with another dose of economic reality. My name is JJ, watching Bull Boom Bear Bust. And yes, I'm refreshed. I took a few days off. I had to kind of think about what I wanted to do with the channel. I knew I was going to continue, but if you watched that last video, you know that there's been a big drop off in viewers. So a lot of you gave me some good tips, good information, and what I learned was that a lot of people are leaving YouTube. I actually didn't know that. So I went and researched, some of the stuff that you guys were telling me. So appreciate the support, the tips, the feedback. Thank you to everybody for coming back, of course, and for all of your encouragement. Appreciate that. So I'm gonna be here. I'm gonna drive this thing till the wheel falls off, basically, as the old saying goes. But we got a lot of news to catch up on. It's been a bit since we did a report, so let's go ahead and get right into it here. Here's what we have on tap for today. More strikes are happening. The cost of living is continuing to pound people and their finances, right? So people have to demand higher wages, and that's why we saw a record number of strikes in 2023. And 2024 looks to be headed to be worse than 2023 as far as the amount of people, amount of workers going on strike. We have Cisco laying off people, Amazon, Jeff Bezos selling off a huge amount of stock. We're going to talk about what that likely means. But first, the inflation number. This came out a couple days ago, but this was as we expected. The inflation number was higher than expected. It did slightly drop from December. Consumer price index was 3.1% positive in January from a year ago. Now in December, it was 3.4%. So a slight improvement from December. But one thing that 99.9% of the people miss, just because that number is lower than the previous month, it doesn't mean prices are going down. It means the cost of living is still going up and prices are still going up. It's just going up more slowly than it was before. So instead of losing $100 gambling at the casino, you only lost $95 basically. You're still losing money. It's just you're not losing it as fast. But if you watch a lot of the news channels and the business networks, they're always going to put that out there as positive news. So people are fooled and people keep spending money. I mean, that's the way I look at it. Cisco, let's talk about Cisco cutting 5% of the global workforce. This is just another one in the long string of layoff announcements here. 5% of employees, profits forecasts were light. It's going to be over 4,000 jobs. Cisco stock was down. Now, we're still seeing some pretty good strength in the stock market. And for those of you that have been on this channel, you probably already know that the stock market is owned 90% of all stocks, over 90% now, because at the end of 2023 it went up again. Over 90% of all stocks are owned by the top 10%. So now you know why we see such big moves in times of shock or drastic news when we see a market decline, because all those top people, all those 10 percenters, they get on the sell button all at once, and all the people left holding the bag are usually the bottom 90% and the retail investors. And then, of course, after the stock drops and the top 10% come in and buy the same stock for pennies on the dollar and drive the market back up again. And that's what we saw in 2020 with the big drop. They rapidly bought up the stocks and drove that market again. And now we're at all-time high in most of the indices, maybe all the indices. I have to look at all of them, but I don't want to get into that today. Let's talk about the strike here. LAX workers are on strike now, demanding higher pay. And this comes on the heels of a couple other strikes. We see flight attendants going on strike as well. What I found out about flight attendants, actually, I didn't know. I guess either a lot of them or all of them do not get paid unless they're actually on the flight. So after takeoff is when they start getting paid. So as they're waiting for the plane, as they're on a layover from one flight to the next, maybe they're hanging out at the airport for a couple hours, maybe they're in a hotel, they're not getting paid. And that's really not good, because in order to get on the flight, you have to be there waiting. That's like a job not paying you until you log onto your computer, but yet you had to get to the job. You had to turn on your computer in order to start working, but they don't count that as work. They don't count it as work until you start doing a certain task. In this case, the flight attendants, they weren't paid for actually doing most of the things they do. I shouldn't say most of the things, but I think they should get paid for any amount of time that they're at the airport. But then people will argue against that. They'll say, no, we don't get paid the moment we pull into the parking lot of our job. So why would we have flight attendants get paid before they get on the plane? So you could see that, but is the plane considered the place of employment, or is it the airport? So that's what you got to look at, and that's what they're on strike protesting. The strikers have been working without a union contract since November 19th, and they're not alone. Ultimately, unions representing thousands of airport workers are in negotiations with their employers. And again, you wouldn't see this if the cost of living was somewhat under control, but people are under the gun, so to speak, financially with this cost of living. And you're just going to see more strikes this year. It's going to be really surprising to see all the different industries that are going to be striking. And sometimes the strikers, let's call them the strikers, sometimes the strikers can bend the will of the employer or bend the opinion of the employer if they're essential workers or if they have a lot of skills, if they're highly skilled workers. Flight attendants, there's some training that goes along with being a flight attendant. I have a family member that was in training for several months, actually. I was surprised to know and to learn how long it took to get trained to be a flight attendant. It's not just handing out peanuts and telling people to buckle their seatbelt and doing the seatbelt demonstration, or no, the seatbelt and then the air mask demonstration. Anyways, let's go on to some other news here. Here's an interesting one. The IRS is suing the FDIC over the Silicon Valley Bank failure. That was the bank that failed back in March last year, March or April, one or the other. And it's pretty interesting here. Asking a judge to determine how much the FDIC must pay to cover an estimated 1.45 billion tax debt owed by the failed bank. So pretty interesting. The FDIC, we know, doesn't have very much money. Actually, if you look at the amount of money they have, it's less than, I believe it was less than 2% of all deposits in U.S. banking institutions. That's how much the FDIC can actually cover. So essentially, they're not going to be able to cover everyone if a lot of banks fail at once, or if all the banks fail, of course. And that's why you had to see that meeting, that emergency meeting last year, where the FDIC, the Fed, the Treasury all came together to decide what they're going to do. One of the things they did is they had bigger banks buy up the assets of the smaller banks that failed. And I think that's what's going to be a lot more this year in 2024. We're going to see a lot more consolidation. The big mega banks, they're going to be the ones with constant backing or constant liquidity given to them. So they're never going to fail. And you're going to see a lot of them buy out these smaller banks. And so I do expect a lot more of that. But you've got this implication here with the taxes that are owed. Are they just going to print more money to pay the taxes? Well, that's what it looks like. Just add it to the national debt. I mean, why not? It's already 34 trillion. Why not run it up to 40, 50, 100 trillion? Does it matter at this point? It doesn't. And if this keeps going, we're going to see more inflation. And the surprise last month of inflation coming in hotter than expected, at some point, it's got to be not a surprise. We see these articles all the time. Surprise inflation, surprise inflation. It's not a surprise. If they keep creating money, this is what happens. Look at the countries in which the cost of living went up and never came down. Everything went up. The cost of homes, food, everything went up in many of these countries that saw massive inflation / hyperinflation. And the housing bubble in those countries that people thought would pop never popped. The housing bubble never popped in Venezuela. The housing bubble never popped in Zimbabwe. Lebanon's going through massive inflation right now. And these are prices that are going up that people think are going to come back down. And it's starting to look like that here in the U.S. I mean, prices are really not correcting that much at all. In fact, we're going to talk about real estate here in just a few minutes with what happened here just in the last quarter of 2024. I think it's going to be pretty eye-opening and pretty surprising for a lot of you there. Now remember, we are seeing some parts of the economy come to a little bit of sense, not complete sense, but a little bit of sense. For example, rents just posted the biggest decline in 3 years. That was as of December, and we'll see what the latest month numbers will be pretty soon. That'll be coming out, but we are seeing some corrections in some areas. The price of automobiles, rents, cost of food actually coming down, but still higher. All these things are still higher than they were in 2020. So even though they're coming down, we're still not where we were even back in 2020. So a lot of people are still feeling the pinch, feeling the pain. Let me show you something that I got just recently, though, that's speaking about financial pain. If you're carrying a balance on certain credit cards, especially these store credit cards, take a look at this. Take a look at this, man. I got this from Home Depot. This is the credit card. I actually ripped it and I had to tape it back so I could show you. I forgot I wanted to show you 29.99% APR. That's not the default rate or the rate you're going to get if you're late. That is the rate for purchases. Folks, 30%. When debt is at an all-time high, when people are carrying the highest credit card balances ever, this is what these retailers are doing now. The credit card companies in general, it's about 21, almost 22%. So if you're not paying that card off in full, then you're going to be in big trouble in a short amount of time. And I'm glad I don't carry a balance on any of my credit cards, or if I do, I'll pay it off in full each month. I'm still blessed enough to be able to do that. But people that aren't able to do that, I think you're going to be skating towards insolvency probably in the not too distant future. I'm trying to remember what I bought at Home Depot. I bought a portable generator, so that way if the electricity goes out, you can still run your appliances. It's a big Duramax one. I'm looking right at it. Actually, it's right behind my computer monitor here. So yeah, thankfully I'm not carrying a balance. 30%, not the default rate, the general rate for just purchases. Pretty outrageous. All right, let's jump into real estate here. You know, real estate, the housing market is the backbone of the economy, along with consumer spending. So those are the two big horses, right? Where consumer spending goes, especially credit card spending, and where housing goes, that's generally how the economy is going to go. And people are wondering why we're not seeing a crash or a recession, and that's because banks are still loaning out money. Remember, back in 2008, it was very hard to get a loan. Credit card limits dropped. Banks were freaked out. Banks were scared at the very beginning, or actually on the onset, or at the onset of the crisis, and that caused a whole bunch of layoffs. When consumers stop spending, jobs disappear very, very quickly because consumer spending again is the driver. Close to 70% of what they look at as far as GDP and the calculation of economic growth is consumer spending, and most of that is people swiping credit cards and going into debt. So when banks pulled away the credit and dropped those credit limits on the credit cards, you saw a massive uptick in unemployment. And really quick, before we get into the housing number, let's take a look and see what unemployment jumped up to. And let's go ahead and bring this up here. So if we look back at the 2007, 2008 time frame, we saw unemployment tick up to close to 10%. Did we hit 10%? We did. We hit 10% in October 2009. And of course, that was a result of the pullback in credit, because again, banks at the beginning of that crisis, they were not sure that they were going to be guaranteed life support. Now here we are, tens of trillions of dollars later, and the banks are pretty confident now that they're going to be propped up by the money creation, behind the scenes, and not all banks. I think it's just going to be the big top few mega banks. And I think we're going to, like we talked about at the beginning, we're going to see a lot of smaller regional banks actually fail. I still think credit unions are safe, the safest bet. The big mega banks, though, those have to be safe also if you look at the way that they're guaranteed life support. So I actually wouldn't be afraid to keep my money at one of the big mega banks, because they're guaranteed lifeline. But besides that, credit unions, but the regional banks and the mid-sized banks, I would be cautious. Personally, I would be cautious about keeping my money at those banks. Now, if you look at 2020, of course, we saw unemployment spike up, way worse than the financial crisis. It spiked almost up to 15%. And of course, this is just scratching the surface of the real unemployment numbers. We know that this excludes literally tens of millions of people that are out of the labor force. It's close to 100 million people out of the labor force. But if you look at comparing it to 2008, it could still give you a good snapshot in comparison. And of course, we all know what happened in 2020. The record amount of money creation, all the rescue programs made the rate spike up to an all-time high. The unemployment rate spiked up to an all-time high, but also was the biggest recovery or fastest recovery of all time. In a matter of months, it dropped back down to below 4%. Now, the most recent month, as of January, we're at 3.7%. If banks, again, were to pull back on the credit and drop people's credit card limits, you would see unemployment spike in a very fast way because that's the driver of the economy, right? So as long as they can keep the banks loaning out money, keep people going further into debt, keep the credit limits high and going higher. In fact, if you look at the available credit right now, it's the highest it's ever been. So altogether, banks are not afraid at all right now, even with their high record levels of debt, and that's the key to keeping this economy going and to avoid an economic downturn. And there's some people out there that say, "Oh, I predicted a crash or economic downturn." No, I predicted the economy, and I continue to predict the economy is going to go the way of credit. So if credit's available, you're going to continue to see the markets go up, cost of living go up overall. Um, and that's just the way that it runs now. Is that guaranteed to happen? Well, maybe somebody could throw a monkey wrench in the gears of the credit system, and who knows what that could be, right? Your guess is as good as mine. But if that does happen, maybe you'll see a big correction like we saw in 2020. Will it be followed by more massive money creation and another fast recovery? Yeah, it looks likely. So be ready to buy the dip. That's why I always encourage people here. People, in comments on this channel say, well, give us some solution, give us some action. Have cash in case we do see another correction in 2020. Some of the best investments I've made over the past 5 or 10 years were after the collapse in 2020, especially with the oil stocks and some other stocks. Things crashed down very low. That's when I like to go in and buy. That's a no-brainer there. That's almost uh, a guaranteed win situation. If you buy something after a big collapse, unless it's a company that ends up going bankruptcy, but these companies that are going to be around, consumer staples, and companies that have been around for decades, it's a pretty safe bet, to buy the dip or buy the crash. So if and when we see a crash, have cash available. Not just for that though, but what if we see some more widespread economic fallout? If we do see a crisis within the banks, if the banks somehow are no longer supported and no longer get that guaranteed liquidity that they've come so accustomed to being counted on, or they're counting on endless life support, basically. So could it change? Absolutely, in the drop of a hat. So be ready for something big. Otherwise, prepare for more inflation like a lot of these other countries where prices went up and never came down. Because if they keep throwing money at the problem, if they keep just creating more and more money and adding to the pile of debt that's already enormous, then you're going to see the cost of living continue to go up. So you want to be balanced, in my opinion. You want to have cash ready for a correction, but you also want to have investments in case this thing keeps on going the way of, again, Zimbabwe, Venezuela, Lebanon, Weimar Germany, those places that had the currency get completely destroyed in hyperinflation, right? So be ready for both things, folks. Real estate. I promised we'd get into some real estate here. Let's talk about this. Mortgage delinquencies increased in the last quarter of 2020. It's still 2023, sorry. It's still very, very low. Mortgage delinquency rate was up 26 basis points from the third quarter, but down 8 basis points from a year ago. So we're still not seeing this big spike in mortgage delinquencies. A lot of the homeowners out there right now, close to half of them, locked in a very low mortgage rate since 2020. We saw this big migration happen where people were moving out of the cities and working at home, and a lot of homes being bought and sold, and therefore a lot of people locked in low rates. So will they be set forever just because of a low rate? Well, no, not forever, because the cost of living is eventually going to catch up to everybody. Even if you have a low rate locked in, it doesn't take away the cost of living and everything else that you're paying more for. So, that's going to continue to eat into household budgets. and we'll have to see how the housing market turns. Um, but something else here to notice, Canada, home prices are now down over 18% from the peak. So Canada's home prices are even crazier than they are here in the US, and we're seeing an 18% correction over there, and that's overall. And what that means is some of the cities, the more expensive cities, likely even saw a bigger correction. Actually, let me just give you a few here. Vancouver down 20%, Hamilton 25%, just to name a couple, right? So corrections, they're still possible. So, don't lose hope if you're someone waiting on the sidelines, waiting for a correction or deflation. But deflation is the thing that quote unquote leaders fear the most. So you also got to prepare for the opposite end of that, and that's going to be more inflation. Have investments, have things that are going to go up with inflation, go up with the cost of living. All right, so welcome back, everybody. Again, this is a little bit longer of a report than usual. Thanks for being here. Let me know what you think down in comments. Oh, real quick, Jeff Bezos just sold off several million shares of Amazon stock. So what does that tell you? Bezos unloading Amazon stock, selling 25 million shares worth about $4 billion. That was just since February 7th, so in a week. And there's likely more to come. That brings the total of the shares he sold off now to 50 million. Why is he doing that? Is it because of his new girlfriend? Is she that expensive? Our girl's that expensive? Our girlfriend's that expensive? Maybe if you're Jeff Bezos. I think there's more to it, though. I think there's something going on that a lot of these people see coming. Could it be a week away? Could it be a year away? Who knows? I'd like to hear your thoughts on all this down in the comments. Let me know what you think. Correction, crash, prepare, or is it going to be more inflation? Either way, thanks everybody for watching. We'll talk to everybody very soon. Peace, and much love to all of you watching. Thanks for being here. Bye now.